There's this huge global tug of war going on right now, and what's at stake is basically the future of money. On one side, you've got countries trying to cram this brand new technology into laws that are like 100 years old. And on the other, you have folks building a whole new playbook from scratch. To really get what's happening, we got to go back to the beginning. So picture this, a totally new digital frontier. When Bitcoin came on the scene, that's exactly what it was. It was permissionless, it was borderless, and it was completely outside of the normal financial system we all know. For the early adopters, this was absolutely revolutionary. But, as billions and then trillions of dollars started pouring in, that freedom started to look a whole lot more like chaos. And this brings up a really fundamental question for governments all over the world. How in the world do you regulate a technology that was literally designed to be outside the control of any one person or government? How do you do that without totally crushing the very innovation that makes it so cool in the first place? Well, that's the story we're diving into. This global race to bring some kind of order to that chaos, to go from this digital anarchy to a whole new kind of financial architecture. This slide just perfectly nails the tightrope that regulators are trying to walk. I mean, they have to protect people, right, and stop things like money laundering. But if they clamp down too hard, they risk killing off some game-changing technology. And what's even worse, if the rules are way too strict, the companies will just pack up and move somewhere else with easier laws. That's a little something called regulatory arbitrage, and it's a massive headache for governments that want to keep all that innovation at home. So let's see how this is all playing out in the United States, where the approach for years has basically been a turf war between two super powerful agencies. And they're both trying to shove crypto into legal boxes that were built way before anyone had even heard of the internet. Okay, so at the very heart of the issue in the US is this one simple question, but with no easy answer. Is a crypto token a security, like a share of stock in a company? If so, it falls under the super strict rules of the SEC. Or is it a commodity, more like gold or oil, which would be governed by the CFTC? For years, nobody knew. This disagreement created this massive legal gray area, and it left crypto companies totally in the dark. Now, the SEC's primary weapon in this whole fight is something called the Howey test. And get this, it comes from a Supreme Court case from 1946 about some orange groves in Florida. I'm not kidding. A legal precedent from the 40s is being used to classify this cutting-edge, decentralized technology. You can probably imagine how well that's been going. So for the longest time, the US strategy just felt, reactive. Instead of giving everyone clear rules to follow from the start, the SEC would provide clarity by just suing companies that it thought were breaking the law. This whole approach, they call it regulation by enforcement, and it basically created this climate of fear where innovators were just too scared to build anything because they might get hit with a surprise lawsuit. But recently, the tide has really started to turn. In a huge strategic pivot, these agencies are now signaling that they want to work together. And the goal is crystal clear. Stop the exodus of crypto companies that are fleeing to other countries. The new model is all about regulation by engagement, which is a fancy way of saying they're shifting from fighting to talking. So, the US is trying to adapt its old framework. But what if you just threw out the old rules altogether? What if you built an entirely new system designed from the ground up specifically for this new kind of asset? And that brings us to the European Union, which took that exact radically different approach. They created something called MiCA, that stands for the Markets in Crypto Assets Regulation. And it's a big deal. It's the world's first comprehensive, custom-built, and unified rulebook for the entire crypto industry. MiCA's real strength lies in its three core pillars. It's pretty simple, really. First, protect consumers with really clear mandatory disclosures. Second, make sure the markets are fair by setting rules against manipulation. And third, protect the whole financial system by putting some serious guardrails around stablecoins. So what does this actually look like in practice? Well, it just means legal clarity. If you want to launch a new token, you have to publish a detailed white paper explaining everything. Want to run an exchange? Easy. You get a license in just one EU country, and that gives you a passport to operate in all 27. And if you're issuing a stablecoin, you have to prove one-to-one that you have it backed with safe liquid assets. It's all about making things predictable. And this is where we see something called the Brussels effect kick in. The big takeaway here is that the EU isn't just making rules for itself. Nope, they are effectively setting the global standard. I mean, the EU is such a massive, valuable market that for global crypto companies, it's just way easier and cheaper to adopt MiCA's high standards for their entire worldwide operation. And just like that, EU law becomes the default rulebook for the rest of the world. Okay, so while the EU seems to have a head start, there's a whole different kind of race unfolding in Asia. Two of the world's biggest financial hubs, Hong Kong and Singapore, are going head-to-head to become the region's crypto capital, and they're taking completely opposite approaches to get there. And the contrast is just fascinating. Hong Kong's whole philosophy is, look, people are going to trade crypto one way or another, so it's way safer to bring that activity here into a well-regulated, transparent system. It's protection through supervised access. Singapore, on the other hand, takes a much more cautious view. They're basically saying these assets are just too risky for the average person, so their goal is protection through exclusion by making it really hard for everyday investors to get involved. And you have to admit, Hong Kong's strategy is also a pretty brilliant geopolitical move. With crypto essentially banned in mainland China, Hong Kong is positioning itself to be the only compliant, regulated bridge for Chinese capital to safely get into the global digital asset world. But what happens when a country goes all in? I mean, not just regulating crypto, but making it the law of the land. Well, that's the story of El Salvador's really bold and, let's say, troubled experiment. I mean, the vision here was huge. 70% of its citizens didn't even have a bank account, so the government made Bitcoin legal tender. The hope was to bring millions of people into the financial system and slash the costs of remittances. That's the money that Salvadorans working overseas send back home to their families. The reality, though, was pretty underwhelming. Even with a government-backed digital wallet and a big nationwide push, less than 1% of those remittances were actually sent using crypto. People just stuck with the old surfaces they already knew and trusted. So what went wrong? Well, this top-down mandate just failed to build trust from the ground up. Adoption just never took off. And when El Salvador needed a loan from the International Monetary Fund, they were pressured to walk the whole policy back. It was a pretty stark lesson that a government can't just force a new financial habit on people who are skeptical. So, what does this all add up to for the future of crypto regulation? Let's zoom out and take a look at the big picture. When we lay it all out like this, you can really see four totally different playbooks emerging. You've got the US with its messy, fragmented system that's slowly, very slowly moving from fighting to talking. Then you have the EU, which built this comprehensive blueprint that offers total clarity. Hong Kong is being proactive, building a regulated gateway. And El Salvador tried this radical top-down adoption that just didn't really work out. And this leaves us with one final critical thought. We live in one single interconnected digital economy, right? But it's being governed by this crazy patchwork of competing rulebooks. The US model creates uncertainty. The EU's model gives clarity, but maybe it's too rigid. So as all these different philosophies are out there competing for money, for talent, and for influence, the ultimate question is still up for grabs. Who is going to write the final rules for the future of money?